Hello, everybody. Today, what we're going to talk about is my favorite option spread. Now, in general, option spreading will offer you several advantages, and we'll talk about exactly how the mechanics of option spreading work in a second. But it offers you better risk control, smoother equity curve, uh, oftentimes a higher win percentage, and substantially more flexibility. And by that, I mean you can often rearrange a position that may not be working exactly as you thought and changing it to something that's going to be more profitable for you. So there are a lot of advantages of having an option spread over a straight put and call. But the biggest option advantage for spreads is that it puts us essentially in the position of the floor trader. Now, a floor trader in options is obligated to make a market for the option. So if somebody calls up and wants to buy 1,000 calls on XYZ stock, the option floor trader is obligated to make him a market for those options. So he will sell those puts or calls, and then he will go into the stock and hedge his position in some sort of ratio depending on where the strike price is in the option. But what's the biggest advantage that that floor trader now has? He sold that option, which has a built-in time value. And anyone who's ever traded options knows exactly what I mean. There's an intrinsic value for the option, and then there's a time value, which is the amount of uh, premium that is given to the time between now and expiry. And that is always an eroding asset. And let me show you that this is really the most important part of what we're going to talk about today, and that is the asset decline, the time value of the option. So here we've got 90 days out, and this could probably even be 6 months out, and we show that the time decay on an option that has a lot of time left is slow. But as that option gets closer to expiry, the acceleration of the time decay is much faster. So basically, what we want to do is we want to be the floor trader. We want to capture some of this fast time decay here, and as it works to our advantage. And we would rather be long options that are up here that have slow time decay. Okay, so that this chart is in essence everything that you need to know today. The most important part. You make money down here by being short as decay works in your favor as it accelerates, and that's what we're going to do when we set up the spreads. So let me give you a little explanation of how spreads exactly work, because I know some people approach it with some trepidation that it's a little bit more complicated than puts and calls. But honestly, if it is, that amount of difficulty is very marginal. Look at it like this. I'm sure if you're all familiar with options, you're familiar with the concept of the covered right. Whereas you buy 100 shares of XYZ stock, and you have, say, you buy it at $100, and then you may sell the option to somebody for a specified time to expiry at a specified strike price that they can buy it, and you'll receive a premium of, say, $5. So you buy XYZ stock at 100, you sell the option for $5. If the stock goes down, you keep the $5 and you still own the stock. If the stock goes up, it gets called away. So you keep the $5 still, and you get $100 for the stock. So you essentially sold it at 105. Now it may get called away when the stock's 102, in which case you can go back in and buy it at 102, and you've already pocketed a $5 profit on the stock. So essentially, what we're going to do is instead of owning the stock, we're going to own a long dated option. Remember that last graph that I showed you where the long dated options decay slowly. So we want to be long those. So in the place of the stock, we own a long dated option. And essentially then we're just doing a covered right with a short dated option. And that's essentially what a spread is. So the key takeaway is that time premium always erodes faster on the short dated, and we want to use that to our advantage. Okay. Now, let me give you a basic example of what we would call a calendar spread. This is the same strike price option, but a different expiry. For example, we may buy a February 100 call on XYZ stock at $8, and let's say it has 4 months to expiry, and we can sell a December 100 call at XYZ stock that has a month to expiry, and say we get $2. Now, obviously that nets us a cost of $6. Now, between February and December, we're going to have multiple opportunities to sell against that long dated option to recoup the $6 in time value. So even if this stock was to go sideways, every week we could sell another option, or every 2 weeks, whatever it was, for say $2. If the stock was dead even the whole time, we would just keep selling for $2 and $2, and in 4 weeks we would have recovered our entire $8. Now, that's obviously a hypothetical example. The market's rarely going to just stay at $100 every week for 4 weeks, but that's how that would work. And when I talk about flexibility and less risk, that is what I mean. You own this long dated, but you have continual opportunities to mitigate the cost of that by selling other options against it. Now, the one that I most often use is a diagonal calendar. And instead of having the same strike price, just with a different expiry, this has both a different strike price and a different expiry. And so that way it's more slanted, either bullish or bearish. For example, I'm going to buy that same XYZ 400 call at $8. But this time, instead of selling the 400 call, which would have been a straight calendar spread, excuse me, I'm going to sell the 405 call. Now, I'm going to get less for the 405 call because clearly, if say the stock was 400, the 405 is out of the money, so it has no intrinsic value. So let's assign it a value of 1 for our example here. So we're long the 400 call and we're short the 405 call. Obviously, we're bullishly slanted because we've paid a lot more for our long dated call than we're receiving for our short dated call. And we're thinking that if the stock goes up to 405, well, this is going to be worth 0, and this is going to be worth 11 or something like that. So in that case, and we'll get to this in the next slide, I think here, we would be trying to make money on both sides. So let's go through the various scenarios. Now I've changed the price here to 5 and $1 because I think at the $8 was probably a little bit more than was reasonable here. So I've changed it to $5. Let's say the stock stays unchanged till expiry, where I'm long the 400 out in February and I'm short the 405 in December. Now, because the stock's is unchanged for a week or two, let's say that this option drops to 4.25 because it's going to lose a little bit of time value, not as much as the other one, but it's going to lose a little bit. So it's going to lose, what is that, 17% or something of its time value, lose 75 cents. Now, if the stock's at 400 still when this one expires, the 405, obviously it's worth 0. So it's lost 100% of its time value. So we're going to pocket that whole $1, just the same as we did in the covered right example. So that $1 is ours to keep. So what we've done, what we've done is actually made a profit of 25 cents on a stock that did absolutely nothing when we kind of had slanted things bullishly and had hoped it would go up. It accomplished nothing, but we're still making 25 cents. And that we can, now that it's expired, what we can do then is sell another 405 call and receive another $1. So now our costs, instead of $5 less $1, now it's $3. So you can see what I said, how you mitigate your costs. So even if you're wrong, you're mitigating the amount of money that you've paid out by bringing this money in that they can't take back from you. It's like a covered right. Once you sell it, they can't take it back. You may have to buy it back later, but if you do, that means your long call will also be going up. So you're still in good shape. Now let's say that we're completely wrong. We buy this at 5 thinking it's going to go up, sell the 405, but instead it goes down. So instead of expiring now, this market goes down to 395 and we go, oh geez, this doesn't look right. I'm going to buy this 405 call I sold for $1. I'm going to buy it back at 25 cents and I'm going to take a 75% profit there. Now, in the interim, this $5 one, to be honest with you, has gone probably down to $3. So what we're going to do now is change it into a calendar spread, and here's where I got to the flexibility. So instead of, we buy that 405 back, and now we're going to sell a 400 for $1. So we've made 75 cents. We've now collected another dollar, so we've taken $1.75 of that $5 cost in. So that is how we mitigate. Okay, that is how we mitigate our costs. Now, if the stock goes down further and we decide, okay, like this is just wrong, let me get out. So I'm going to sell that call at $2.50. Remember, because it's a long dated call, it's not going to go down as fast. It's not going to lose time premium as fast as a short dated. So if it gets down to half what I paid for it, I may say, okay, that's enough. Let me out. At that time, I'm going to have to buy back the 400 call at 25 cents. So I've made a profit of 75 cents on that one. I made a profit of 75 cents on the first 405 call I bought. So I lost $2.50 on the original long dated option. But I made $1.50 by those two 75-cent profits. So instead of having a $2.50 loss, now my loss is only $1. That's 60% better than the 400 call position if I left it alone. Right? So instead of having a $2.50 loss, I've only got $1 loss. So you can see what a benefit it is to be set up like this in the spread, especially if you're wrong. Now let's say that the stock rises to 410. Okay, so now honestly, before it got that high, I would probably do something to rearrange it, which I'll show you in a bit. But let's say that it gaps up. Let's say that it closes at 404, and then the next day it gaps to 410. Oh, geez. Well, it's gone the way I want, but I wanted to have a chance to do something a little more flexible. So now the long dated rises to at least $11, so you'd be up $6 on there. But the short dated, it rises to $5 because it's a 405, right? So, and it's at expiry now. So the difference between the 410 where it is and the 405 strike at expiry is $5. So we have to buy this one back. We're going to lose $4. But we made $6 here. Now, if we had have previously done those two previous sales at 75 cents and $1, we would also add that into our $6. So we would be at $11 to sell it, and then plus the $2 for receiving the short dated options, and then we had to buy those back at $5.25 and $5. We paid out $10.25 that were received in 13. So we still made a profit. We did it. In fact, talking about mitigating, we did a little bit mitigate our profit over what it had been had we just had a straight put or call, but we still made a profit, and we took advantage of time value. Now, occasionally you will get caught in a situation like this where it actually does cut your profit a little bit, but in most cases, because the time's working for you, you are going to benefit from having a spread versus a straight put or call. But I just want to be straight up that not in every case it's possible that you can actually mitigate your profits a little bit too by using a spread like this. But it's important to show you both sides of the equation. Now, now let's say that the stock didn't gap up to 410. Right? And this is the other scenario where we talked about flexibility. Let's say the market gets up to like 405 and I go, oh, geez, okay, this looks like this 405 may expire in the money, and it's still got time left. So I'm going to buy that 405 back for $3. Now I'm going to sell a 407 call now, which has a little further to expiry, saying maybe it's another further week out, and it's a 407 versus a 405, and I'm going to sell that for $3. So these two are basically a wash because I have to buy this one back that I originally sold for $1 at 3, but then I sell this 407 at 3. And we'll see in a minute why we do that. Now at expiry, if the stock finishes at 410 again, like it did in our previous scenario, this time we paid out $5, and then we had to buy that one back at 3. And since it was a 407 and the option, the stock closed at 410, it's also worth $3. So we paid out 5, we paid out 3, and we paid out 3 again to buy this 407 back. So we paid out 11. But we received that initial 75 cents, $3 plus 10.50, so 14 and a quarter. So I'm saying that that option at 410 is worth at least 10.50. It's probably worth 11, so this would be 14.75. So our profit is the difference between those two, what we paid out and what we paid in, obviously. So in this case, you're looking at a $3.75 profit. Okay, so by rolling it up to the 407, it gave us a little bit more profit potential than had we left the spread at 405. Now, it's really, if you followed all that, well, good for you. It's a little bit complicated to roll this stuff out and explain it on a just looking at the numbers without seeing it on an actual a chart graph and explaining the various scenarios. So good for you, but I want you to know the concept. I think hopefully by now you've grasped the concept, and the intricacies of rolling it out become pretty clear before too long. What I want to do here is just show a recent example of a trade that we actually did in target zone, perhaps give a little bit better understanding of how this works in real time. So this is Chevron, and I want to just blow it up to a big time picture here. When the stock was down here where I got in, I was well aware that we had this long-term trend line coming in up here towards the high 150s. Okay, so I'm going to take that trend line out, but I wanted to let you know that that was my target for this expected up move that I was going to have in Chevron. So that'll come into play in a second. So I'm long the call options right here in October, and I choose to go out to February or so, January, to buy a 150 call with the stock just about 150. So I'm going to pay $6 and a little bit for that option out in January or February. Now, I'm expecting the market to go into the high 150s. As I said, that's where that downtrend line comes in on the weekly. So the high 150s, 160s is a good target for me. So if I'm long the 150 out in January out here, out in the distance to the right of this chart is my expiry, I'm going to sell a close expiry for November. And I'm going to choose the 160 because that's just about the area where I think that the market could get to. So I buy out here in February for $6.50, say, and I sell in November for $1. And I can't remember the exact numbers, but these are numbers that are representative of what prices are approximately were. So nothing happens for a while here. As you can see, I'm long back here, and all I get is a bunch of chop. And I am somewhat protected by being short this option up here. Now, it's decaying, obviously, a lot more rapidly than the February is. So as it loses most of its value, that dollar or so that it has to lose is just about what the January option has also declined, because we're sitting through this chop here and it's not doing anything. Now, all of a sudden, boom, we decide, oh, actually, I do want to go up. And at this point now, the February option is really starting to move up because it's now becoming in the money. That is, the price is moving well above 150, whereas this 160 call isn't moving very much at all because it's running out of time. and it's still quite out of the money. That is, price is still quite far below the strike price. So we sit through this, and then we come up here. And at this point, the 160s are starting to gain a little bit of traction again once the market gets up into the, to the high 150s. So at this point is a good time to take back that 160 option and sell my long dated 150 option. Because remember, this is the area, the high 150s, where I wanted to get out. So I sold this option here originally for $1, and it did provide me a little bit of security as I had to wait through this crap here, back here. Now, as it gets towards 160, this $1 option might have been back here. It might have been down to 25 or 30 cents. But as the market starts to get closer again, it's now accelerating back up. So at this point, I'll buy back this option for 50 cents. So I sold it for $1, and I bought it back for 50 cents. So I made a 50-cent gain there, just as good in my pocket as the floor traders, right? Now, this long option that I bought at 150 when the stock was about 150, the stock's now in the high 150s. So it's gone from $6.50, say, to $9.50 or $9. So I'm going to make $3 on this one. I'm going to make 50 cents on this one. So I make $3.50 on the whole thing. Now, that's an extra 50 cents that I would have made just being long the call. And not only that, I had a little bit of protection here while things were moving sideways and waiting for the trend that I thought was going to happen to assert itself. So there was not only a profit on it in the end, there was peace of mind right here. And it made the whole thing a little more palatable before it went where I thought it was going to go. Now, let me give you some hypothetical scenarios. Let's say that the stock had stalled out here and that option 160 just expired worthless. I'm still going to own this February. I've now pocketed the dollar for the 160, but now the stock's in the high 150s. I can sell 160 again that has maybe only a week to expiry or 2 weeks and get another dollar for it. So that would be hypothetical, but if that expired in this option, and then I could go out another week or two and sell another one for $1 or $1.50 or whatever was available. So now I've mitigated my cost of the 650 by $2 by selling another option, and I'm exactly the same position. If the market goes up to 160, I'm going to make great on here, and I'm going to make twice on that short option here. So that's why I like the diagonal spread. It allows you to take a position, but it allows you some flexibility to wait the position out. It mitigates your losses if you're wrong, and it provides an opportunity to make money on both sides of the equation. Now, let's say that at some point, I'll give you one further example, that this market stalled out here, for instance, and it's the 153. So my 150 is up a little bit. My 160 is going to go to zilcho. So I make $1 there, and I decide, well, you know what? I'm not as bullish on this as I thought. I could just sell the 150 and make a profit out of it. Or this time I could turn around and I could sell the 155 call, right? So I could go here and sell the 155 call. Now, instead of getting $1 up here, I'm going to get $2.50 for the 155 because it's a lot closer. It may be a little bit in the money even, right? But I know I'm going to make money on this 150 if the stock holds above 155. But if it goes down, I've protected myself by getting a couple of dollars by selling this 155. So if it goes down, now I've collected the $1 for the 160, the $2 for the 155. Now I've collected $3. So I've collected 50% of the cost of my long dated option. Okay? So if it stops at 155 and expires there, I pocket those $3. If it goes to 158, I have to buy this one back at $3, the 155, but my 150 is now worth, $9. So It's a win-win. I may have mitigated my gain just a little bit if it goes up, but I'm still making a gain. And if it goes down, I've certainly well mitigated any potential loss. So that's part of the flexibility that you have to do when you're doing these vertical spreads. And like I said, it's not complicated. The excuse me, the long dated option essentially takes the place of a stock, and all you're doing is a series of covered rights. Now, I want to address one last point here, and it was a really good one. The last webinar we did, somebody talked or asked a question about what if you're exercised on the short option? And I know that can be uh, a surprise and hence maybe sometimes an intimidation for some folks, but there's absolutely no reason for that. Remember that, and I think some of that intimidation comes from the big numbers that they see come across their screen. Remember, every stock or every one single option represents 100 shares of stock. So if you're doing, say, an option on the SPY, one option represents $50,000 worth of stock. So if you have 5 options, you're essentially trading $250,000 worth of stock. Now, if you're exercised on that short option, what they do is they go, oh, okay, here's your $250,000 either coming in or out of your account. But that really is here nor there, because what you're going to do the next day is you're going to liquidate the assigned stock, either buy it or sell it, and simultaneously you're going to liquidate your long option. So by being assigned the stock, what is essentially happening is you're buying back the option for its intrinsic value. Let me say that again. By being assigned the stock the next morning, what's going to happen is you're going to essentially, by liquidating the stock position, you're essentially going to be buying the option back for its intrinsic value. Okay, no different, exactly the same. Okay, so you'll simultaneously liquidate the stock position that you're assigned and also liquidate your long-term option. So there's no more risk or anything crazy like that in being assigned than if you had bought back the option for its intrinsic value. The key is the next morning, you just liquidate both the long option and the assigned stock at the same time. All right, that concludes today's webinar. Thank you for listening. If you have any questions about anything we talked about today, Joe Duffy, 6813 at gmail.com, and thanks again.